What if the modern financial system was born not from stability, but from collapse? What if the foundations of central banking, paper money, and speculative markets were built on one of the greatest financial disasters in history? And what if the man responsible was not a king, not a warlord, but a gambler who believed he could manufacture wealth out of thin air? In the early 18th century, France was on the brink of economic suffocation. The death of Louis XIV in 1715 left behind a kingdom that appeared magnificent from the outside, but inside it was drowning in debt. Decades of warfare and extravagant spending had pushed the monarchy to the edge. The national debt was estimated at roughly 2 to 3 billion livres, an overwhelming burden for the time. Interest payments consumed state revenues, commerce was slowing, confidence was fading. And when confidence disappears, economies freeze. Into this fragile moment stepped John Law, a Scottish mathematician, former dualist, and financial thinker who believed he understood something others did not. Law had studied banking systems in Amsterdam and England. From these observations, he developed a radical idea. Money was not gold. Money was trust. It sounds obvious today. In 1715, it sounded dangerous. Law argued that France's problem was not a lack of wealth, but a lack of liquidity. Wealth existed in land, trade, and labor, but without circulating money, economic activity stalled. If France could increase the money supply through paper notes backed by confidence rather than metal, trade would accelerate, prices would stabilize, debt could be managed, growth would return. The regent, Philippe II, Duke of Orleans, faced with few alternatives, agreed to give Law a chance. In 1716, Law founded the Banque Générale. It issued paper notes that were initially backed by deposits of coin. The notes were easier to use than heavy metallic currency. Merchants adopted them quickly. Transactions became more efficient. Economic activity began to revive. For a moment, it worked. Confidence grew, trade increased, the experiment appeared successful. In 1718, the bank became the Banque Royale, officially backed by the French crown. The state itself now stood behind paper currency. This was a turning point in financial history. France had effectively adopted a proto-central banking system. Paper money backed by government authority circulated widely, and it did something extraordinary. It made people feel richer. That feeling changed everything. But Law's vision did not stop at banking. He aimed to solve France's massive debt problem directly. His solution was bold and complex. In 1717, he acquired control of the Mississippi Company, which held trading rights in France's Louisiana Territory in North America. The company promised enormous potential wealth through trade, land development, and colonial resources. Investors could exchange government debt for shares in the Mississippi Company. This converted public debt into corporate equity. The logic was simple. Instead of the state struggling to repay debt, investors would hold shares in a company expected to generate profits from colonial expansion. It was financial engineering centuries ahead of its time. And then speculation began. Shares in the Mississippi Company rose rapidly during 1719. From around 500 livres, prices climbed to nearly 10,000 livres at their peak. Paris became electrified. The Rue Quincampoix filled with traders shouting prices. Nobles, merchants, professionals, and ordinary citizens rushed to participate. The story felt unstoppable. Fortunes were made in weeks. Paper wealth multiplied. Law became the most powerful financial figure in France. He controlled the bank, the money supply, and the largest trading company in the kingdom. And here is where the psychology becomes important. Rising prices attracted more buyers. More buyers pushed higher prices. Higher prices reinforced belief in limitless opportunity. The bank issued more notes to accommodate demand. Investors borrowed to buy additional shares. Credit expanded. Optimism intensified.
It was a self-reinforcing system fueled by confidence. But beneath the surface, reality lagged behind expectations. Louisiana was not producing immediate rivers of gold. Trade revenues could not justify soaring valuations. The expansion of paper money outpaced metallic reserves. The system depended entirely on continued belief. And belief, once shaken, moves fast. In early 2020, some investors sought to convert paper notes into gold and silver. Others quietly sold shares to secure profits. Law attempted to manage the situation through policy adjustments, including restrictions on specie withdrawals and changes to share structures. Instead of calming markets, these measures signaled fragility. Panic spread. Investors rushed to exit. Share prices collapsed. The feedback loop reversed. Falling prices destroyed confidence. Destroyed confidence accelerated selling. The Mississippi bubble burst. By mid-2020, the system had imploded. Fortunes evaporated. Public anger intensified. Trust in paper money collapsed for decades. Law was dismissed and fled France, eventually dying in relative obscurity in Venice in 1929. The experiment that promised prosperity ended in crisis. Yet the most fascinating part of this story is not the collapse, it is what survived. John Law's central insight that money functions as trust rather than metal proved historically correct. Modern economies no longer operate on gold standards. Major global currencies are fiat money, backed not by precious metals, but by government authority and collective confidence. Central banks today actively manage money supply, interest rates, and liquidity to stabilize economies. Governments finance operations through bond markets supported by investor belief. The core mechanisms that define modern finance resemble the structure Law attempted to build. The difference is scale, regulation, and institutional development. And here is where the modern relevance becomes clear. As of early 2026, global debt has reached approximately $348 trillion US. That's more than 3 times global GDP. Modern financial systems operate heavily on credit expansion, sovereign bonds, and central bank liquidity management. Confidence remains the invisible backbone. When confidence rises, markets expand. When it falters, volatility erupts. The pattern Law experienced is not ancient history, it's a recurring cycle. Innovation introduces opportunity. Opportunity attracts capital. Capital inflates valuations. Optimism spreads. Leverage increases. Then a trigger appears. Confidence shifts. Markets correct. We saw versions of this pattern during the 1929 stock market crash. We saw it in the 2008 global financial crisis when excessive credit expansion in housing markets collapsed under its own weight. We observe similar psychological dynamics in modern speculative episodes involving digital assets and high-growth equities. The instruments evolve. Human behavior does not. John Law was neither purely villain nor pure genius. He recognized that money could be engineered. He understood liquidity's role in stimulating growth, but he underestimated the limits of belief. His failure was not in recognizing the power of credit, it was in expanding it faster than economic fundamentals could support. That tension remains central today. Monetary expansion can prevent recession. Liquidity can stabilize markets. But if expansion detaches from productive output, distortions accumulate. The lesson is not that financial innovation is dangerous, it is that innovation requires discipline. Trust must be preserved. 3 centuries later, the story still feels contemporary because it addresses a timeless truth. Economies are psychological systems as much as mechanical ones. Markets are not cold equations, they are networks of expectation. When expectations align with reality, stability emerges. When expectations outrun reality, instability follows. The Mississippi bubble was the first large-scale demonstration of this dynamic in a modern financial structure. It exposed both the power and the fragility of credit-driven growth. And here is the final hook. If money is trust, then the most valuable asset any economy possesses is confidence. Not gold reserves, not stock indices, confidence. John Law attempted to amplify confidence through policy and persuasion. For a moment, he succeeded spectacularly. Then, confidence collapsed. The world did not abandon his ideas, it refined them. Today's financial architecture is more complex and more globally interconnected, but it still rests on the same invisible foundation he identified: belief. The story of John Law is not simply about a bubble in 1720, it's about the birth of modern finance. It's about the recurring tension between innovation and excess. Whenever a new financial revolution appears, whether technological, monetary, or speculative, it carries the same dual potential.
It can unlock growth or amplify risk. History does not repeat perfectly, but it often rhymes closely enough to warn us. And perhaps that is the true legacy of the first great financial experiment. Not that it failed, but that it revealed how closely prosperity and panic can coexist inside the same system. The next time markets surge and optimism feels unstoppable, remember Paris in 1719. Remember how quickly paper fortunes rose. And remember that behind every financial system lies something more fragile than gold: trust. And that's the story of how one financial experiment changed the world, proving that money isn't metal, it's belief, and belief can build empires or break them overnight. If this video gave you a new understanding of how markets really work, make sure to like and subscribe.